are we going to talk about this continual correction that is really hurting my portfolios? I'm sure it's wrecking yours with the stocks I've been buying this week. As we'll look at the ETFs, the individual stocks I personally love, but roll back and review this damn news between tariff war, inflation, pardoning criminals, and so much more. So if you are on a path to financial independence, if you want to retire early, guys, we got to do this together. It is a volatile market, it is a wild ride, and I want to be on that roller coaster with you. So damn well hit that subscribe, because we got to talk about Trevor Milton. If you do not remember, the CEO has currently been in prison for basically vapor wearing, pumping and dumping Nikola, a competitor to Tesla that is now basically declared bankruptcy. Well, this dude's been sitting in prison, has got a pardon. Trump pardoned this guy. I can't believe it. Today, I was issued a full and unconditional pardon by Donald Trump himself. He called me personally to tell me, which is kind of crazy. Just picture this guy sitting in prison and picking up the phone, and it's Donald Trump. Seems kind of peculiar. According to the federal prosecutor, Milton misled investors by stating that Nikola had built up a pickup truck and basically from the ground, and that it had developed its own damn batteries, even though he knew they were buying them. And that basically had early success creating the Nikola One, which was a semi-truck that he knew did not work. You remember there's videos of this truck that was driving, and really they were just pushing it down a hill, rolling it like it was a complete fraud. And if this company is able to operate and this CEO is able to get pardoned, what does that say for people like Elizabeth Holmes or even Sam Bankman-Fried? If all these guys were just on the borderline of telling the truth, why are they all in prison? You know, I mean, it's just kind of hilarious to me, and we'll see how this kind of pressures moving forward. But on the back of Trump doing incredible things, our prime minister here in Canada has decided to fully roll back, basically saying that the relationship with the US is over. And this has stirred up quite a bit of drama. Basically, Canada's Prime Minister Mark Carney said that Canada's old relationship with the United States, based on deepening integrations of our economies and tight security and military cooperations, are basically over, which is crazy. Speaking to reporters in Ottawa after the cabinet meeting, Carney said Canadians must fundamentally reimagine our economy in the face of the U.S. President Donald Trump's tariffs. And we'll just take a quick listen to this anecdotal video here.
The President of the United States is trying to fundamentally restructure his economy. It means our economy, and it means the global economy as well. And I understand and respect his goal to support American workers, but I disagree with him that this is how to help them. I reject any attempts to weaken Canada, to wear us down, to break us so that America can own us. That will never happen. And our response to these latest tariffs is to fight, is to protect, and to build.
So obviously Trump does not like this rhetoric. He's still trying to control the narrative as Canada looks for new trade partners and to open up further deals. And Trump recently, literally, apparently like 1 or 2 in the morning, tweeted basically, if the European Union works with Canada, in order to basically do economic harm to the United States, which I don't think is the implication here, the large-scale tariffs, far larger than currently planned, will be placed on them both in order to protect the best friend that each of these two countries has ever had. So I guess we're not calling Canada the 51st state anymore. And of course, as soon as I was editing this, Trump just tweeted out that finished speaking with Prime Minister Mark Carney of Canada. It was an extremely productive call. We agree on many things, and we'll be meeting immediately after Canada's upcoming election to work on the elements of politics, business, and other factors that will end up being great for both the United States of America and Canada. Thank you for your attention to this matter, which time will tell how the market takes effect when these tariffs come into play at the beginning of April. And just taking a look at my personal watch list, there is far and few between stocks on here that are actually green today. Like, I mean, literally just PSA public storage, like they're the fewest of few companies. And if you look at the S&P 500, a lot of technical traders, you know, did kind of call this a dead cat bounce. We didn't really go into a full recovery, and I welcome this because I still think things are a bit frothy, but I don't think the reason the market is pulling back has as much to do with Trump as it has to do with the recent, data that came out from the Federal Reserve. And we'll just read through this because this is the claim that, U.S. stocks fell sharply on Friday as Wall Street grapples with the President Trump's escalating trade war and basically weighs signs of reinvigorating inflationary pressures as consumer sentiment plummets. And in focus Friday morning was the release of the Personal Consumption Expenditures Index, which includes the Federal Reserve's preferred inflation gauge of core PCE. The reading showed prices increased more than expected last month, rising about 0.4% month over month and 2.8% year over year, continuing the stubborn plateau on the path to the Fed's target. And we know that if we can't get inflation down to 2%, the Fed's not going to cut. But between this tariff war, spending, nothing is going in the way I think Trump is expecting it to go, and I think the markets are going to continue to go down. And I want to talk about that a little bit because I don't think most recent investors are prepared for what a flatlining, downturning market can do to you, like psychologically. Because if we look, a lot of investors are continuing to hide out this week in the lower half of the market, right? These are your dividend-oriented stocks, the safe haven, the recession-proofs, as they like to call them. But the real deals that are opening up are in the upper-weighted, I think, tech companies still. If we take a look from peak to trough right now, the S&P is only down about 8.91%. If we zoom out over the 5-year, I think so often people forget the correction that we went through in 2022, where the market didn't actually hit an all-time high for 2 straight years. I mean, from 2022, the end of coming into 2022, right to 2024, the market was just going down and flatlining. And I love market environments like this because if we look at the S&P 500's price to earnings multiple here, we've been going back into a frothy area, and we all know this. I mean, when the president's pumping a meme coin, crypto meme coins, constant pump and dumps everywhere, overvalued stocks based on AI and promised futures that don't exist, you have to recognize this is a very valued frothy market. But now what we're getting is something similar to, I think, is what happened in 2022, which is you're going to see stock values, earnings continue to go up because I still think we're in a strong market environment, and we're going to see stock prices come down on the back of future concerns, which all in all brings us into a healthier market environment. But it can last a while. You got to prepare yourselves that this could go on, and you have to keep cost averaging because market sideways for a year or two is not the worst thing I think could possibly happen. On the Canadian side of the border, however, I'm shocked to see that the Canadian market's holding up incredibly strong on the back of this tariff war, which is insane because the S&P 500, their VOO is down 4.44%, whereas VCE, the same index but represented for the Canadian companies, is actually flat on the year. But that might also have to do with the tailwind of interest rate cuts because our government is cutting interest rates aggressively. It might be bolstering the economy a little bit more on the back of this tariff war, so we're kind of getting a bit of a balancing act, but time will tell on where this goes. If we look at my personal holdings with my investments in the Canadian markets, SCHD for some of those dividend recession-proof plays, so to speak, and then of course the S&P 500. Obviously the S&P has been the dragger in my portfolio. It's also one of the largest positions I hold, but it's nice seeing a little bit of a balancing because I'm not down nearly as much as the US markets because of the cushioning I have with these dividend ETFs, which actually are mostly flat into the end of the year. So it's great to see, and even XEQT has been holding up quite nice for those that again are broadening their horizons outside of the United States, because we have seen Europe start to perform exceptionally well. China's been having a bit of a comeback here. It's an endless reminder to broad base your exposure because you don't know what's going to perform well and when. And obviously XEQT is a great Canadian ETF, but you can also look at things like VT. And as I age into a wealth preservation phase, it's something that I have been more and more finding myself heading toward as the logical choice with a hand select amount of individual stocks. And let's talk about the individual stocks. But before we do, I do want to remind you that this is a market cap weighted ETF. You can't compare the S&P 500's PE that's currently sitting at 28 to VOO or any of these indexed ETFs because they operate a bit differently. If we take a look, the growth rate right now on VOO is 19.4% on a year-over-year basis over 5 years. If you take a look at like the earnings growth, it's basically defined as the average annual growth rate basically in earnings over the past 5 years for the stocks in this portfolio. And that is pretty incredible, right? On the back of a PE that's sitting at about 27 right now. So if that earnings growth remains as strong as it is, and we do continue to see this price to earnings correction, I'm saying, like, you have to recognize that we are in a new era of growth. This isn't like a traditional era where we saw companies growing at 10 to 15%. We're talking about double-digit growth rates on an entire index, right? And if we look at the stocks driving some of that, stocks that I personally hold that I bought over the last little bit on these dips that continue to dip, the dippity dip that I'm running out of money to buy for, is Google right now trading at 158, heading below a 2 trillion market cap, back into the teens for a price to earnings multiple on a company that does have has experienced a double-digit growth on revenue. If we look at the net income or even just earnings per share growth, absolutely astounding at 30% for that last quarter, with shares outstanding being bought back aggressively. Whoo, baby, the formula to get rich is here. I mean, look at Meta. Yeah, I can't get over that Meta is only down 2.2% on the year, kind of giving up the insane gains, the AI gains that it experienced, trading at a bit of a higher value than Google, but probably deserved at a smaller company that has more room to grow. Again, growing at 20% double-digit paces, with earnings per shares coming in at astounding 50% growth rates. Like, these numbers are nuts to me when I look at the earnings ratio. Now, this company's not buying back shares as aggressively, but they are buying back some shares nonetheless. When I look at these two companies, they are the easiest continuing to be buys in in the market, and they make up some of the largest single stock positions in the wife and I's account. And I sleep ever easier at night knowing that. My next biggest bet, however, and the one I really want to share with you a funny story, is Take-Two Interactive when it comes to GTA 6. And this is just something to finish on a lighter note. I'm always really like fascinated by like consumer spend on products like this, and if this legacy still holds up when GTA 6 drops this year. And it seems like investors are pretty confident that it's going to hold that astounding legacy and probably propel this stock to new highs, as it actually hit new all-time highs, being one of the better performers I bought over the last month or two. But take a look at this. I just want to share anecdotally this video. It's friggin' wild, going all the way back to the early 2000s.
Upstairs bedroom of this upstate New York home, a group of 13-year-old boys is carrying out a reign of terror on screen.
Oh man, this is bad.
That would put them on the nation's most wanted list in real life.
It's my general object of this game. Kill as many people as you can, get as many stars as you can.
They're deep into a video game called Grand Theft Auto 3, where players assume the role of an escaped convict who hijacks cars, guns down pedestrians,
Aw, dude.
has sex with a prostitute,
Want me to shoot her?
Yes.
then earns extra points by killing her, so he can snatch back his money.
It's as close as you can get to like killing someone without like being arrested or really killing someone.
There are plenty of violent video games on the market today, but what sets Grand Theft Auto 3 apart is the game's stunning realism.
The stunning realism of
GTA
2002.
3, as it is commonly called.
Anyways, I think this video it's so fun watching the legacy of some of these video game companies. But I just wanted to share that on a lighter note because I think it's hilarious. But I'll pass the question off to you. How are you guys surviving this market? What are you buying? I'd love to hear about all of it in that comment section below.